almost sterile, as if the room had been carefully prepared for a moment that would echo far beyond its walls. A president spoke calmly on television, and the world nodded along. Most people remember that address as a technical policy shift, wrapped in language about stability and national interest. But beneath the smooth delivery and measured tone, something far more structural was taking place. It was not simply politics. It was the ledger overheating and the balance sheet quietly acknowledging insolvency. Most people believe money loses value because prices simply rise over time. That explanation is easy, comforting, and widely repeated. But the deeper truth is more deliberate. Purchasing power does not disappear randomly. It shifts, gradually and systematically, as pressures build inside the financial system. Somewhere in the background, a crisis is being postponed. Somewhere, a reckoning is being deferred. And often, ordinary households serve as the buffer that absorbs the strain. Imagine the ledger as something alive, not emotional, not political, but mechanical. It does not respond to speeches or slogans. It responds to columns, to numbers, to alignment. When those columns drift apart, adjustments must follow. And in modern economies, those adjustments rarely announce themselves loudly. They arrive quietly through subtle changes in value, cost, and opportunity. In the middle of the 20th century, the United States appeared financially invincible. Factories ran late into the night. Suburban neighborhoods expanded rapidly. A single income could support a household, fund vacations, and build savings. The national balance sheet looked strong from every visible angle. Productivity was high. Wages were rising. Confidence was widespread. The dollar carried weight in those years. It felt dependable. One paycheck could cover appliances, fuel, groceries, and still leave room for savings. Store shelves were full, and long-term planning seemed rational. The prevailing belief was not merely that prosperity existed, it was that prosperity would continue uninterrupted. Yet beneath that confidence, structural pressures were building. Government spending expanded. International commitments grew. Programs multiplied. Much of this expansion was financed not by immediate taxation, but by borrowing. Borrowing works smoothly for a time, especially when growth is steady. But borrowing accumulates, and accumulated obligations require either repayment, restructuring, or dilution. Every economic system has a preference. In this era, the preference became clear: growth without immediate sacrifice. Credit made this possible. It allowed spending in the present while postponing the cost. It felt painless. It felt efficient. But habits built on credit tend to scale. What begins as a convenience becomes a dependency. That, in this context, is not simply a statistic. It is a structural force. It expands quietly when conditions allow it. It thrives in environments where liquidity is abundant and discipline is flexible. At first, it stimulates activity. Later, it restricts options. The transition between those two phases is rarely obvious until it has already occurred. Behind elected officials and public institutions lies another powerful influence: the market for money itself, interest rates, bond auctions, global capital flows. These mechanisms operate without sentiment. They respond to risk, return, and confidence. When confidence wavers, financing becomes more expensive. When financing becomes expensive, balance sheets tighten. Originally, the system included a constraint. Gold reserves limited how much currency could be issued. That constraint imposed discipline. By the late 1960s, however, the arithmetic grew strained. Dollars circulated globally in quantities that exceeded the gold available to back them. Foreign claims increased. Outflows hazy, the numbers no longer aligned comfortably. By 1971, the pressure had become mechanical rather than theoretical. Too many dollars were tied to too few anchors. On that August evening, the suspension of convertibility effectively removed the external constraint. Dollars would remain dollars, but they would no longer be exchangeable for gold at a fixed rate. It was described as temporary. It proved permanent. Some called it a shock. In reality, it was an adjustment to maintain continuity. The system did not collapse. It adapted. Money became backed primarily by confidence and productive capacity rather than metal reserves. This shift allowed flexibility. It also removed a natural break. In 1973, another lesson followed. Energy prices surged, and the effect moved rapidly through the economy. Oil influenced transportation, manufacturing, heating, and agriculture. When energy costs rose, the impact spread broadly. Inflation became visible not as theory, but as lived experience. By the late 1970s, rising prices were embedded in daily life. Savings accounts yielded returns that lagged behind inflation. Households noticed that each year required more income to maintain the same standard of living. The erosion was gradual but persistent. In response, interest rates climbed sharply in the early 1980s, reaching historically high levels. Borrowing became expensive. Mortgages slowed. Economic activity cooled. Inflation moderated, but the adjustment carried costs. High rates stabilized currency, yet they also strained heavily indebted entities, including governments. Through the 1990s, globalization and technological expansion reshaped cost structures. Manufacturing shifted geographically. Supply chains stretched internationally. Imported goods helped contain visible price pressures. Consumers benefited from lower prices on many products, even as asset prices, particularly equities, climbed steadily. The pressure did not disappear. It relocated. Housing markets strengthened. Stock markets rose. Retirement planning became increasingly tied to financial markets rather than guaranteed pensions. Households were encouraged to participate in asset appreciation to secure their future. In the early 2000s, interest rates declined again. Credit expanded. Mortgages became widely accessible. Refinancing became common. Many decisions centered on monthly affordability rather than total obligation. Rising home values reinforced optimism. Then, in 2008, that optimism faltered. Financial institutions faced severe stress. Credit markets froze temporarily. Confidence deteriorated quickly. Policymakers intervened with large-scale support programs to prevent systemic collapse. The immediate crisis stabilized, but the long-term architecture shifted further toward abundant liquidity. Saving yielded minimal return. Investing felt necessary to maintain purchasing power. Asset prices appreciated, particularly in housing and equities. Wage growth, however, often lagged behind asset inflation. When 2020 brought global disruption, fiscal and monetary responses were swift and substantial. Relief programs supported households and businesses. Liquidity expanded rapidly. The measures prevented deeper contraction, but they also increased the money supply significantly. By 2022, inflation accelerated to levels not seen in decades, with U.S. CPI inflation approaching 9% year-over-year at its peak. Essentials, fuel, food, housing reflected these increases clearly. For many households, the strain was immediate and practical rather than abstract. Consider the household perspective. A worker earning $38,000 in 1999 might earn $62,000 in 2024. On paper, income has increased significantly, yet housing costs, healthcare expenses, education, and everyday goods have risen as well. Nominal gains do not automatically translate into stronger purchasing power. Purchasing power is the real metric. It measures what income can actually secure. Over long periods, inflation reduces the value of currency units. This is not sudden. It unfolds gradually, year by year. Charts tracing the consumer dollar show a steady decline in purchasing capacity across decades. At the grocery store, the change is tangible. At the housing market, it becomes structural. Down payments grow larger. Mortgage terms extend. Rent consumes a greater share of income. What once felt attainable may now require additional years of saving. Households respond by adjusting behavior. Some take on additional work. Others delay major milestones such as home ownership, marriage, or starting families. Consumer credit provides flexibility, but it also introduces long-term obligations. By late 2024, U.S. credit card balances were reported near $1.28 trillion. That figure represents convenience, but also cumulative reliance on borrowing to manage expenses. Minimum payments make debt manageable in the short term, yet interest compounds over time. Student loans add another dimension. Borrowing for education can increase earning potential, but it also creates obligations that follow graduates into their early careers. Medical expenses introduce further uncertainty, particularly when unexpected events occur. Meanwhile, aggregate economic indicators may still appear positive. GDP can grow. Markets can rally. Yet growth at the macro level does not guarantee ease at the household level. Growth can coexist with tighter margins for individuals. The pivotal shift in 1971 removed the monetary anchor. Since then, the system has relied heavily on policy calibration, interest rate adjustments, liquidity programs, fiscal interventions. These tools are powerful, but they require balance. Too much liquidity risks inflation, too little risks contraction. In such a system, sovereignty and solvency are closely linked. Governments must maintain credibility in bond markets. Households must manage their own balance sheets carefully. Neither can operate indefinitely without regard to arithmetic. The most significant changes rarely occur in dramatic public moments. They occur gradually. A higher rent renewal, a larger insurance premium, a grocery bill that surprises. Over time, these increments reshape expectations and behavior. Inflation functions like a silent transfer mechanism. It shifts purchasing power without formal legislation. Those who own appreciating assets often offset its effects. Those dependent solely on wages feel it more directly. Generationally, the impact compounds. Long-term obligations can span decades. Decisions made during one economic phase echo into another. Financial resilience becomes less about sudden windfalls and more about sustained discipline. Parents adapt by teaching children practical financial awareness. Young adults evaluate career paths not only for passion but for stability. Entrepreneurship weighs potential against healthcare access and fixed costs. Choices narrow when margins shrink. The system can still produce opportunity. Innovation continues. Markets evolve. Productivity improves. Yet the underlying arithmetic remains constant. Expanding money supply without proportional productivity growth places upward pressure on prices. Understanding this dynamic shifts perspective. Success is not measured only in higher nominal income, but in preserved purchasing power. Monitoring personal balance sheets becomes essential. Cash flow, savings rates, debt ratios. These metrics determine resilience. Liquidity provides oxygen during downturns. Excessive leverage increases vulnerability. Inflation reduces the real value of idle cash, but can also erode fixed incomes. Balance is the central challenge. The ledger remains open. It records expansions and contractions without commentary. It responds to policy, to markets, to behavior. The broader narrative is not about catastrophe, but about structure. It is about how systems evolve when constraints are removed and flexibility increases. History is not decided solely by speeches or announcements. It is shaped by balance sheets, by incentives, by cumulative decisions. Those who understand the mechanics adapt more effectively. They focus not only on income growth, but on purchasing power preservation. The lesson is neither alarmist nor cynical. It is structural. When money becomes more abundant, prices adjust. When borrowing expands, obligations accumulate. When inflation rises, purchasing power declines unless income or assets outpace it. The story that began in 1971 continues today. It unfolds in interest rate decisions, fiscal negotiations, and household budgets. It is present in asset valuations and in grocery receipts. It is subtle, persistent, and measurable. And for those willing to observe carefully, the signals are visible. Not in dramatic headlines, but in steady charts, in compound interest tables, in long-term purchasing power graphs. Arithmetic does not argue, it balances. The question is not whether the ledger will continue writing, it will. The question is, who reads it closely enough to adjust before the margins tighten further? If you zoom out far enough, the pattern becomes easier to see. Each decade carries its own justification for expanding credit and liquidity. In one era, it is war. In another, recession. In another, technological transition or public health emergency. The reasons differ. The mechanism remains consistent. When pressure builds, more money enters the system. When more money enters the system, the value of each unit adjusts relative to goods, services, and assets. This does not require conspiracies to function. It requires incentives. Policymakers are rewarded for stabilizing the present. Markets reward growth. Voters prefer continuity over contraction. Very few participants are rewarded for imposing immediate austerity in exchange for long-term discipline. And so, the path of least resistance tends to involve expansion first, correction later. The correction phase is rarely symmetrical. Asset prices can rise for years, compounding optimism. Adjustments, when they arrive, tend to be faster and more emotionally charged. This asymmetry shapes behavior. People extrapolate recent trends. If housing has appreciated for a decade, it feels permanent. If markets have recovered quickly from past downturns, risk appears manageable. Memory shortens. Leverage increases. At the household level, this creates a subtle psychological shift. Stability becomes defined not by savings, but by access to credit. A high credit limit can feel like security. A rising home valuation can feel like liquidity. Yet both depend on conditions that can change. True resilience is quieter. It is built on manageable fixed costs, diversified income streams, and liquidity that does not depend on asset sales. Consider the mathematics of inflation over long horizons. A 3% annual inflation rate seems modest. Over a single year, it is barely noticeable. Over 20 years, however, it reduces purchasing power significantly. At 5% or 7%, the compounding effect accelerates. What once required $50,000 annually may require $80,000 or more, simply to maintain parity. Income must grow not just nominally, but in real terms. This is where productivity becomes critical. If wage growth aligns with productivity gains, purchasing power can stabilize. If productivity lags behind monetary expansion, prices adjust upward instead. The tension between these forces defines much of modern economic policy. Central banks attempt to calibrate interest rates carefully, aiming to cool inflation without triggering severe contraction. It is a narrow corridor to navigate. Interest rates function as gravity within the system. When rates are low, borrowing expands. Projects that once seemed marginal become viable. Asset prices often rise as discounted future cash flows appear more attractive. When rates rise, gravity strengthens. Margins compress. Speculation retreats. Highly leveraged positions face pressure. Neither state is inherently good or bad. Both shape incentives differently. Demographics also play a role. An aging population may save more and spend less, influencing growth patterns. A younger population may borrow more, invest more, and consume more. Immigration, labor participation, and technological automation all interact with monetary policy. The ledger captures these interactions without commentary. It simply records outcomes. Technology introduces another layer of complexity. Digital payments accelerate transactions. Algorithmic trading amplifies market movements. Information spreads instantly. Expectations adjust faster than in previous generations. This speed can magnify both optimism and anxiety. Markets reprice rapidly. Narratives change overnight. Yet beneath the volatility, the arithmetic of debt and purchasing power continues steadily. Housing remains central because it combines necessity with leverage. Shelter is non-optional. Mortgages magnify exposure. When rates decline, affordability improves temporarily, supporting higher prices. When rates increase, affordability tightens, often slowing transactions. Over time, land scarcity, zoning policies, and construction costs further influence supply. The result is a structural upward bias in many urban areas, interrupted occasionally by cyclical slowdowns. Education and healthcare follow similar patterns. Both are essential. Both have experienced cost increases that often exceed general inflation. Financing mechanisms, loans, insurance, subsidies, enable access, but also embed long-term obligations. Households plan around these realities, allocating larger portions of income to non-discretionary categories. Retirement planning illustrates another structural evolution. Defined benefit pensions once shifted longevity risk to employers. Defined contribution plans shift that risk to individuals. Market performance, contribution discipline, and timing now influence retirement outcomes more directly. This increases personal responsibility, but also personal exposure to volatility. None of this implies inevitable decline. Economic systems remain adaptive. Innovation creates new industries. Efficiency gains reduce certain costs. Energy transitions may alter long-term input prices. Artificial intelligence and automation could enhance productivity in ways not yet fully measured. The future is not predetermined. It is shaped by decisions layered over time. However, awareness matters. When individuals understand that nominal growth can mask real erosion, they adjust differently. They negotiate salaries with inflation in mind. They evaluate investments not just for return, but for risk-adjusted durability. They maintain liquidity buffers. They reduce unnecessary leverage. They focus on assets that generate cash flow rather than relying solely on appreciation. On a broader scale, fiscal discipline and monetary credibility remain foundational. Trust in currency depends on responsible stewardship. Bond markets monitor deficits. Rating agencies assess sustainability. Investors evaluate long-term trends. When confidence remains strong, financing remains accessible. When confidence weakens, borrowing costs rise, reinforcing constraints. The interplay between confidence and arithmetic defines the modern era. Confidence can delay adjustment. Arithmetic ultimately enforces it. This enforcement does not require drama. It can unfold gradually through higher refinancing costs, slower growth, and tighter household budgets. The adjustment may be distributed rather than concentrated. In practical terms, the lesson is straightforward. Monitor real purchasing power. Track expenses relative to income growth. Understand the terms of debt agreements. Consider fixed versus variable rates. Diversify exposure across asset classes. Maintain emergency reserves. These principles are not new. They are simply more relevant in an environment where monetary flexibility has replaced hard anchors. The story that began decades ago continues quietly in spreadsheets, policy meetings, and family budgets. It is not a single event, but an ongoing calibration between growth and restraint, between expansion and discipline, between liquidity and stability. The ledger does not predict the future. It reflects the present with precision. Those who study it carefully recognize patterns before they become headlines. They see that sustainability depends not on optimism alone, but on balance.